Hi, this is John Camarianos. Welcome to a new edition of Capital Considered. It's been a minute. I often get asked whether someone should own an S&P 500 fund or a domestic stock fund or a total world index fund, owning the whole world or the global stock market. Um, it varies from person to person. Some people have stronger preferences on this than others, depending on the client. But let's take a look at what I think is the main difference. Let's look at the top 10 holdings of the Vanguard S&P 500 ETF, ticker symbol VOO. This data is as of September 28th, so it's about a week old. Look at the top 10 stocks. They're basically all tech stocks except for the last one, Berkshire Hathaway, Nvidia, Microsoft, Apple, Amazon, Meta, which owns Facebook, Broadcom, two classes of Alphabet, which is Google, Tesla, which is technically a consumer discretionary stock, but may as well be a tech stock. It's close enough. And then finally, Berkshire Hathaway, Warren Buffett's conglomerate. Together, these 10 stocks comprise 37.88%, or they did on September 28th, of the S&P 500 or of this S&P 500 index fund. That's a lot, nearly 40%. So almost $40 of every $100 you put into this index fund is going into these top 10 stocks. On the right, you'll see the Vanguard Total World Stock ETF. The top 10 holdings are nearly identical: Nvidia, Microsoft, Apple, Amazon, Meta, Broadcom, the two Alphabet share classes, Tesla, and then last, Taiwan Semiconductor instead of Berkshire Hathaway. So in a way, an extra tech stock. But these top 10 holdings comprise 21.74, almost 22% of the index. That's a lot less. So $22 of every $100 invested is going into these top 10 names. You can see each single name's weighting is lower in the world stock market index than in the domestic or in the S&P 500 index. So it depends on how much concentration you want in those top 10 names, which may depend on how significant AI is going to be. And remember, AI could be significant for our lives and for the economy, but that doesn't mean that that's not already priced into the shares of these top 10 tech stocks that are so involved in AI. So that's the judgment you have to make, whether all that AI will ever be is priced into these stocks, which may make them expensive or at best fairly priced. So I wanted to show also, if you buy just this iShares ETF, this is the iShares MSCI ACWI, as we call it, ex-US. So this is the world stock market minus the US. So the whole rest of the world, if you're looking at the world from an American perspective. These are the top 20 names. They begin with Taiwan Semi, Tencent, ASML. So the top six, Taiwan Semi through SAP, are tech or software companies. And then HSBC is the first non-tech holding, which is, of course, a big international bank. Then you have AstraZeneca and Roche and Novartis, which are drug companies. Nestle, of course, a food company, and on down the list. So a fair number of this index of the rest of the world's market are tech names as well. But the rest of the world index is much less concentrated in technology than the U.S. index. You have a lot of drug companies here. You have oil companies, Shell. You have an industrial company, Siemens. Banks like HSBC and Royal Bank of Canada, Toyota Motor. You have a car company. So you have different enterprises, different kinds of businesses represented in the top 20. So it's a personal decision. I think I favor the global stock market right now. I'm a little wary of having $40 of every $100 invested in the stock market going into the top 10 U.S. tech stocks. That bet may pay off. I can't say I'm convinced it won't, but the U.S. stock market, the judgment you have to make is whether it deserves to be seemingly overpriced on a variety of metrics, whether those stocks, those top 10 tech stocks, deserve the valuations they have, the price to earnings ratios that they have. I think I'd prefer 22% than nearly 40%, but that's a judgment every investor has to make for himself or herself. In any case, this is John Comariano signing off for Capital Considered. Thanks for watching.
No information on this podcast should be construed as investment, tax, or legal advice. This podcast is not an offer for advisory services or to buy or sell securities. Before making any financial decisions, consult with a qualified professional advisor who can assess your individual needs and circumstances. Past performance is not indicative of future results, and all investments carry risks, including the potential loss of principal. Securities discussed in this podcast may be holdings of the host or his clients.